This is a show which gets you a complete wrap of all the stocks. Thanks for tuning in to Bloomberg Quint. We're talking about the budget and its implications, but more importantly, the mood around the market, which the day immediately post the budget wasn't the healthiest. Don't look at the index and look at the flat close, but look at what's happening at the broader end of the spectrum, and not just on Monday, but over the last few days, and the market tells you a completely different story. To talk about all of that, the macro, the micro, and of course the budget as well. Joining us is Neelkanth Mishra of Credit Suisse. Needs no introduction. Neelkanth, good having you. Thanks so much for joining in. Neeraj here. Let's start off with the budget though, because that's the big talking point, and then we'll talk about the other things. Your report suggests that you believe that the fiscal consolidation goes ahead undisrupted. What a few people have written though, and maybe valid arguments, is that the revenue assumptions, tax assumptions seem a bit ambitious. It's an expansionary budget, and not just for FY20, for FY19 as well. The math might just change a little bit going into April and May. How would you react to that? Are you still completely convinced that the consolidation process goes ahead undisrupted?
Absolutely. See, I think like in most things in corporates or in large groups, it is about the targets that you set yourself, right? So if you had a 3.2% this year and a 3.5% next year, it would have given absolutely the wrong message. And once that cat is out of the bag, then it's very hard to bring that in. So I think the fact that they stuck to 3.4 and a 3.4 for next year in terms of messaging was a very important one. There are only two messages. The first one was this, and the second, that there is a 75,000 crore consumption stimulus attempted to be given at the bottom of the pyramid in a very novel form. But other than that, everything else is going to be redecided in July this year. So the rest of it, frankly, doesn't matter that much. When it comes to tax assumptions, see, the direct tax growth of about 15% is actually much lower than what they've delivered in the last 2 years. The corporate income tax growth of 13% is only marginally above what we have at about 11.5% nominal GDP growth that they've assumed. On expenditure growth of 13.3%, if you assume a 11.5% growth in nominal GDP, as a percent of GDP as well, it is not really that big an expansion, because the last several years the expenditure to GDP ratio has actually come off. So some kind of a reversal should have been expected, and the fact that the reversal is not really extraordinary is something that we should take comfort from. See, we have to always, as economists, keep track of political cycles. We have also gone through the pay commission cycle. We may have discussed in the past that in the fifth pay commission, the expenditure to salaries for states and center put together went up by 2% of GDP over 2 years. In the sixth pay commission, they went up by 2.5% of GDP. This time, they went up by 1% of GDP only, and the aggregate fiscal deficit, which just got shot in 98 and then in 2009-10, this time is actually still broadly in the same range. This is a phenomenal achievement. So now from here to 2026, the fact that salaries and pensions will not rise at that pace actually releases fiscal space. I mean, we calculated by FY23, this releases 1.1% of GDP worth of fiscal space. So I think we are getting too pessimistic on the fiscal math here.
Okay, let's buy that point. Just for the near term though, and I take on board your point that the math will change come July, but you would have to argue that because there is constraint of capital, it's not a rich balance sheet, the government probably had a choice to either give some bit of stimulus through consumption or some bit of stimulus through Capex. They've chosen consumption as the mode to go ahead. Would you believe that Capex spend would come back? And the problem with that argument, just a follow-up question up to that, Neelkanth, the problem with that argument that that's almost every single time a new government or the existing government faced by electoral compulsions would find it very lucrative to give a consumption boost because it reaches the electoral straight away. Who kickstarts the Capex then? Because private sector is not going to do that.
Well, that's something that we have done a lot of work on. The first is that a lot of the spending of Capex, if you look at aggregate Capex, I mean, including extra budgetary spend in FY19, which a lot of people thought would see a steep decline because of all the so-called profligacy or slippages on tax revenues. There have been some, not denying that. But I think the growth, the extra budgetary in FY19 is actually far higher than what was there in the budgeted numbers. So that the RE was much bigger than BE. I think it's also important to keep in mind that the central budgetary expenditure on Capex is only about 25% of aggregate public sector spending on Capex. So about 70-75% is state governments plus central public sector enterprises. So I think there was a point. See, this is where perhaps we need to get a new generation of economists to start looking at the economy, that people are still stuck to that muscle memory of 91, where almost all the Capex was done by the government. I don't think that is necessary. In fact, our report in December, we showed that the GFCF growth in private corporate Capex, and this is data, right? So this is MCA 21 database that the CSO uses, that was growing at 14% CAGR, above nominal GDP growth between FY12 and FY17. And very contrary to what is widely believed, the public sector Capex as a percentage of GDP was flat. So it has been growing at 11% FY12 to 17, and it was growing at 11% FY17 to 19. So the fact that public sector Capex has been driving all this expansion and my God, it's going to slow down is something that just doesn't appear to be right when you're looking at the numbers. So no, I don't think, and plus you have to understand, if you want to give a stimulus, see, there are horses for courses. If you are doing a lot of Capex on roads, you are doing a Capex on railways, there is clearly, see, if you see consumption numbers, I mean, to the extent that the quarterly GDP numbers are credible, I mean, they are the best available metric, the private final consumption expenditure growth in the last 3-4 quarters has been very bad, which means that broad-based consumption was not doing well. And we've all often discussed, even on your show, that weak food prices are creating a problem. So, while this is not a solution to the farming productivity problem, this is at best a ameliorative measure wherein you're putting a balm on a wound, you're not healing it, but this balm was needed, and I think this sort of supports the economy in terms of consumption growth and the slowing momentum that we are seeing. So there are many other stress points in the economy. So I'm not completely opposed to this idea of giving a consumption stimulus at the bottom of the pyramid.
Okay, so then brings me to my next question then. Or what do you expect a couple of days from now in terms of the rate action? Because God knows, if you look at the NBFC space and the banking space, they are all crying for some bit of rate action from the Reserve Bank of India, if only for sentiment, if anything else. The Fed has probably given a bit of an opening in the door if indeed Shaktikant Das wants to go ahead, or the Shaktikant Das plus the MPC wants to go ahead and cut rates. You, I think, are one of the people who is not in the camp of the belief that there'll be a rate action this time around.
Yeah, see, when we are dealing with what the MPC will do and not what should do, then your analysis has to be very different. So one analysis is what they should do. I mean, I've been thinking they should have been cutting rates 1 year back. So there's no denying that. I think rate cuts are needed. But from the perspective of what they will do, that's when you have to bring in more sort of variables into the picture. The most important thing is that if you're on a tightening bias, if you end up cutting rates, then you are pretty much telling the market that for all of the coming 5 years, till the time that this vintage of economists and analysts and market traders are around, no one is going to believe you when you say, oh, we are going to a tightening bias. So what's the meaning of a tightening bias if you are going to cut rates when you're in tightening bias, right? So I think the first step has to be to clear the way and move to neutral or an easing bias, and at least acknowledge that there is a growth problem. And then if the inflation stays where it is, then you cut in April. I think that's a more sensible way of doing it. And that's why I think that this will be more a change of stance than really a cut in rates. But yeah, I mean, I'm aware that a lot of people are already talking about a cut in rates. I think that should, and it would not be the right thing to do.
Okay, I would love to talk about the Fed out here too, but I think since we've spoken about the rate action and financials back in India, just want your view, Neelkanth, on how do you view the current scenario? If IL&FS was something that nudged people's attention to the crisis, now we have 2 or 3 or potentially more large or larger corporates in a situation which looks eerily similar. How do you view all that's happened? What's happening in the NBFC space currently?
So the first lesson is that no corporate sort of goes under. I mean, just like we've often. I mean, I think the reality about banks is that no bank goes belly up because of insolvency. They go belly up because of lack of liquidity, and I think the same holds true for corporates as well. So many corporates were technically insolvent even 6-7 years back, but they were being kept alive by injections of liquidity. What has happened in the last 4-5 months is that as liquidity has tightened, and it's very important that policymakers be aware of that as liquidity has tightened, a lot of groups which were on the fringe, so maybe they are not, maybe they are solvent. It's just that the lack of liquidity has created enormous stresses on them, and therefore some of these problems are precipitating in ways which they would not have foreseen, and neither could we. And I think this problem, if not addressed very quickly, can actually start creating more problems. From an economic growth perspective, I mean, imagine the fact that, and we have discussed this in the past as well, that if NBFCs were 30% of incremental growth in the last 3 years, the fact that most of them are currently struggling for survival and just shoring up and hoarding liquidity so as to tide through these tight times, I think, well, the fact that they're not growing is actually a problem. And you see that. I mean, like in the jewelry business, I mean, some large listed companies are gaining tremendous market share. I mean, our analysts believe that they've now got pricing power as well, because they don't need to cut prices to compete with the local jewelers, because the local jewelers who are relying on loan against property, etc., to get their working capital are now really struggling. The same is starting to show up, I think, in many supply chains as well. So the distributors and wholesalers, I think, are at the margin. See, this is not steep enough or sharp enough like it was in the global financial crisis, which is why it is very hard for company boards to figure out when they should be extending extra credit, because there's always in an organization a conflict between the sales team wanting more and more credit to the channel and the finance team saying that no, we need to be more disciplined. And in this case, it takes a while for the companies to figure out that it is actually a liquidity problem, what appears to be a sales problem. And I think it is starting to appear, which is why it seems that the economy is slowing very sharply in the last several months. So this is a problem which needs to be addressed, and one hopes that something will happen, and big blow-ups will not happen. But even in the absence of that, I think the growth penalty is already visible.
Yeah, you would have thought this through completely, Neelkanth. One of the key sources of funding for NBFCs, mutual funds, and there is certainly a bit of a liquidity crisis situation, right? I mean, for all the right reasons, media has been highlighting the fact that mutual funds, in the case of Z, the standstill, etc., that has been agreed upon, are all practices that we haven't quite seen in the past and ever happen. And whether it's in the right interest in terms of a fiduciary duty that a fund should, always extend is questionable as well. What happens over the next 3 months if the moves that you alluded to are not taken and liquidity or the lack of it comes back and hits funds and thereby the system really hard?
So first we have to view this in the context of the regulatory environment. See, the fact that the regulators and I think most observers, including us, wanted some kind of a disintermediation of banks as well, that we were overly a bank-dependent economy, has kind of played out. Generally, regulations and economic change happen in boom and bust cycles. So we had a very strong boom. Clearly, it exposed certain chinks in our regulatory infrastructure in terms of the data that was available, or as you were highlighting, in some of the practices. So the non-banking environment was deliberately left sort of less regulated, because you need to not stifle them with too much regulation. But perhaps there is a better meeting ground, and there can be changes made. So that's a learning curve for the system as a whole. And hopefully, they will not be over tightening and overbearing regulation. And so the flexibility that has allowed some of these mutual funds to operate the way they have. Wherever there's been misuse of fiduciary responsibility, of course, I think needs to be corrected, but some kind of flexibility, I think, is required, which is why if you see how NBFCs deal with say, mortgages or developer loans, is very different from how a bank would deal with it. Now, what happens in the next 3 months is a pretty deep question. I think, as I said, the economic momentum is slowing. I think there are a large number of, actually let me not say large number, but quite a few corporate houses which are currently, I think, getting affected by the tightness in liquidity. Clearly some regulators have started acting, so questions are being asked about sources of funding and so on and so forth. And one assumes that in a week or so, I mean in a few weeks and hopefully sooner, that some kind of action will emerge. In the absence of that, the economic momentum, I believe, will continue to weaken. And so let me tell you that this is not as big a systemic problem in terms of solvency issues, right, as some of the earlier episodes have been. Sure. This is primarily a confidence and liquidity problem. I mean, there is a solvency problem in some assets and sure, some entities, but by and large, that's not such an issue. And the banking system is still lending. The banking system is still lending, so it will not be a cataclysmic slowdown. But yeah, but I think the growth penalty will be paid for this.
Okay, just wondering, Neelkanth, one more question on that before I just get in your final thoughts on the markets as well. Do you reckon that the composition of the Indian NBFC pecking order or landscape will change dramatically post this? In that, okay, let me try and explain my question. I mean, we've seen that in the case of certain promoters, because of the liquidity issues, there has been a change of ownership, even if the organization has not gone belly up and it is still surviving and will probably continue. Do you think that is the extent of damage that will happen, or do you reckon that some businesses might stand to get wiped out? This is not GFC and therefore not all, but do you think some at the core of this issue, NBFCs or large leverage organizations, might stand to get go out of business as well?
Absolutely. So I think we need to, and this is where the insolvency for financial firms, the law that was brought about, perhaps was necessary, because then they would have had a framework to deal with these kind of issues. But right now we don't. I think see, as I said, the regulations. Perhaps, I mean, even the regulators may not have thought about how large these entities could become. Having even if you think about entities with NBFCs which have a named business group in front of their names, where if your loan book is say 90,000 crores, and you suddenly discover a hole of 10,000 crores. I mean, the fact that those NBFCs were getting funding in the comfort that large business group will eventually bail them out, and that they will not let a bankruptcy stand against their name. I mean, will that group be able to shore up 10,000 crores to just protect their names? And those are, I think, deeper questions that hopefully will get resolved in this. And the role of the rating agencies. I mean, how many are being rated by agencies which take their job seriously? I think all of those questions will, I think, kind of get sorted out. But this process will take many months, and I think there will be a problem of growth in the interim.
Okay. Let's work with an assumption that this doesn't worsen too much, Neelkanth. In that scenario, with that hypothesis, what's your view on the markets currently? Because while the headline numbers on the index may show a flattish Nifty or a flattish Sensex or a Nifty Bank, the underlying market breadth or pains in portfolios paints a completely different picture. What's your sense of what happens from now until May, June, if indeed that has a big bearing, and post that as well? What happens to the markets?
Right. So you're absolutely right that the Nifty and the Sensex, even the BSE 100 for that matter, have been in an incredibly narrow range in all of 2018. So, we did this comparison of, look at the minimum level of Nifty in a year and the maximum level of Nifty in a year. What's the gap? And the gap of 17% last year was the lowest ever. Right, so the headline index looks remarkably stable, but underneath that, within the index as well, of course, there have been big moves, and the real pain is in the broader market. So what we used to call the next 400, so the BSE 500 minus the BSE 100, I think, been absolutely slaughtered. You have in order to find outperformance in some of these indices over mainstream indices, for example. If you were to say that, let's have when should you have bought the small cap index or the mid cap index so that you were outperforming the Nifty or the Sensex, you already have to go back to like Jan 14 for the small cap index. So unless you had bought it there, I mean, you've been underperforming the Nifty. So this is a very painful process. I think the reality is that they are far more exposed to the domestic economy. They're also a lot more domestically owned, in the sense that the concerns around political instability will affect them a lot more than they will the mainstream stocks. And that's perhaps the reason why, if you see the upcoming elections, I mean, our view is that in the historically as well, the Nifty and the Sensex have not really been that badly, not much affected by election outcomes. In fact, if I plotted the lines to you for the Nifty and the Sensex going back to 96, you would be hard put to figure out where the election results happened. But you can't say the same for the mid cap and the small cap names. And therefore, I think the impact there, the uncertainty there could be much greater. So in terms of outcomes, our view is that so long as the global equity markets remain stable, I think the Nifty and BSE 100 maybe even could remain within a broad range, not too much of pain. But I think outside of that, things can remain very choppy. Within the Nifty, our overweights remain, IT services, some of the private banks, because irrespective of who comes to power, I think they'll keep growing at a certain pace. We also think the industrial Capex cycle, as we were discussing earlier on, and that's something that people are very, very skeptical about. Though it has started to become more of a consensus trade, a lot of houses have been pushing industrials as a stock, as a sector to be preferred. But I don't think the PE multiples demonstrate that, and therefore those are sectors that we would prefer to be in.
Yeah, and probably metals as well. I heard you in an earlier interaction say that you are maybe tactically bullish out there for the next 6 months. Okay, my final question, Neelkanth, and that is that I know by the nature of the coverage that you have that you guys cover the larger names more, but my question would be that in terms of earnings, maybe 5 or 6 companies will drive the numbers for the Nifty 50 over the course of the next 3 to 6 months. That's a overwhelming consensus view out here. What happens to the earnings of the companies from 51 to 200? Do you think there is earnings growth possible there, or within your coverage universe, do you reckon that there will be earnings pain as well? Forget what the market does, but just pure earnings.
See, the fact that bank earnings are a big drag on the headline numbers, I think the fact that they're off is a relief. I think IT services, by and large, of course, it's a very consolidated sector, but by and large, we should see decent dollar revenue growth. I think on the industrial side, we should see reasonable growth for some of the PSU banks as well, and this could be a year where they start to report some kind of profits. So I'm not too pessimistic. You're absolutely right. See, I mean, this is not just in this year, but any year. I mean, till the largest PSU bank and the foreign auto company listed in India, till they've reported their numbers, it's very hard to figure out where the Sensex and or Nifty EPS is. So 2 or 3 stocks do have a very, very large impact on index EPS, but I think that the earnings outlook unless we see a much more serious outcome of this financing of financial system stress, which seems to be developing, hopefully it will dissipate. I mean, we are all optimistic that maybe something will happen and they will dissipate. But if this becomes worse, then there could be, I think, serious downgrades. But for now, I'm not too worried about, at least in the top 100 stocks, to see meaningful downgrades. So you remember that we were a bit worried about the consumption stocks, but with this stimulus that has come in, 75,000 crores is quite a sum of money. And this, I don't think whatever happens in July, I don't think this will be unwound. This will support volume growth for the consumption stocks as well, the consumer staples in particular. So I think by and large, we should be okay on the earnings side.
Keep in mind Neelkanth Mishra's comment that such a move has never happened in the past in any of the countries. Therefore, difficult to figure what a move of this nature will lead to in terms of behavior by the people who get the money. Okay, Neelkanth, great having you. Thank you so much for taking the time out today and speaking to us at Bloomberg Quint. Really, really appreciate your time.